Es un placer saludar a Jay Pelosky, él es fundador de TPW Advisory. Jay, thank you so much for your time and for giving this interview to Negocios Televisión.
Thank you, Marta. Very happy to be with you again.
Jay, the last quarter of the year will likely be volatile given the uncertainty induced by the rebound in energy prices. Investors are showing less confidence on inflation, consumption and central banks' attitude. Will be inflation temporary, as central banks announce, or should we be worried?
I actually am of the view that we shouldn't be worried about inflation. Actually, I've felt that way all year and wrote a piece last February saying that the way to be successful in investing in 2021 is to not pay any attention to inflation. And for the most part, that's worked out pretty well. I think the issue here is that the markets had to absorb a lot of different concerns over the last couple months, the Delta variant, the different things going on in China, some of the political questions going on in the United States with the debt ceiling and the infrastructure plans. And now most recently, we have the issue of the Fed taper and, of course, the energy price spikes in Europe and elsewhere. I think the market has done a pretty good job of discounting most of that, and actually I'm quite constructive on risk assets in the fourth quarter. I think the markets are primed for a fairly significant rebound into the end of the year as we start to think about 2022 and what I believe will be a synchronized global expansion, really the first synchronized global expansion since COVID began.
And meanwhile, central banks stay focused on their mandate. What can we expect from them?
Well, I think it's clear the Fed is going to taper. We're most likely going to get that announcement next month. The Fed meets early in November. They will be tapering. Many other central banks, particularly in the emerging countries, have already raised rates. I think the ECB will be one of the last central banks to raise rates. And we have the PBOC in China that is ready to provide liquidity if need be. And folks are concerned about growth in China. The PBOC has the ability to cut rates. Rates there are, for example, in the 10-year Chinese government bond is close to 3% versus 1.5% in the U.S. and minus 20 basis points for the German Bund. So the Chinese have room to cut rates if need be. So I believe that the markets are prepared for the Fed taper, and I think the issue is really going to be that synchronized global expansion and the earnings that are likely to come as a result of that expansion. That's what's going to support equity prices. That could obviously lead to higher interest rates, and that's one of the reasons why we're not very keen or excited about government bonds, either in the U.S. or in Europe.
Talking about Europe, stagflation risk returns for investors as gas prices surge. Jay, is this risk real? Which could be the impact on markets?
Yeah, no, I think that's a really important question, Marta, as we've seen in the last couple of days. These things seem to just come out of nowhere. I would remind the audience that we've already seen these kind of price spikes in lumber, for example, in the United States, or iron ore, and now we see it in natural gas. Obviously, and in coal. Obviously, the concern with energy is the impact on power and ability to keep the lights on and keep people warm in the wintertime. So it's not quite the same as iron ore. But I do think, importantly, this is going to be a temporary issue the next several months. I just before we spoke was looking at the forward future contracts for the Dutch natural gas benchmark price, which is the benchmark price for Europe on the whole. And the April contract is trading at 47 euros versus the November contract trading at 98 euros. So that gives you an idea. This is an issue for November through February, let's say. And I do think that governments are clearly acting and are going to shield first the consumer, then the utilities. And we have to remember that the modern economies in Europe and the United States, for example, are 70 to 80% service related. And so the amount of impact of higher energy prices today versus 20 or 30 years ago, there's no comparison. It's going to be much less important as a, let's say, a broad economy-wide issue than it would have been 20 or 30 years ago.
In the subject, what do you expect from Wall Street earnings?
I think earnings are going to be quite good. Q3 earnings in the United States are starting already, really ramp up next week. Tomorrow, Friday, we have the jobs number. That's an important indicator for the market. And then we go into earnings season. The consensus expectation is for 21% earnings growth year over year. And then Q4 is better. And next year, consensus is about 10% earnings growth in the U.S. I actually think earnings growth will be stronger in Europe, stronger in Japan, and stronger in some of the emerging markets in 2022 than in the United States. And so one of the things that as we think about looking globally, we have positioned our model portfolios to be overweight Europe, Japan, in some emerging markets like Russia, for example, that benefit from the energy price increase. We think earnings will be one of the main underpinnings supporting higher stock prices as we go through 2022.
And considering the current market scenario, where do you see investment opportunities?
Yeah, I think the opportunities are actually quite significant. We are very bullish on Japan. Japan had a nice move over the last month and then gave virtually all of it back in the last 2 weeks. It's down almost 10%. Japan is one of the few major economies that will grow faster in 2022 than it did in 2021. So we like Japan. We like Europe, particularly in the cyclical and value segments like financials. We think are very attractive in Europe. We like Russia, as I mentioned, as an energy play, kind of a backdoor energy play into Europe. Within the United States equity market, we are very focused on cyclicals and value. We think we're in the early stages of a transition away from growth stocks to cyclical and value stocks. We think that that is going to lead to a bear market in treasuries that's already kind of underway, but we're going to see higher rates in the U.S. in the next 6 to 9 to 12 months. So a bear market in U.S. treasuries. So we stay away from treasuries. And the other segment we like a lot is in the commodity space. Both old energy, fossil fuels, as well as clean energy like carbon. We also are focused on thematics like the battery electric vehicles and electric vehicle batteries, cars, etc. We really believe that climate is the single biggest global macro trend for the decade of the 2020s and believe investors need to be focused on it and paying attention to it.
For your recommendations, Jay Pelosky, founder and principal of TPW Advisory. It's been a pleasure.
Thank you, Marta. Great to see you again.